Okay, think about that disinfectant spray under your sink for a second. Or, the cold medicine you reach for. Ever stop to think about the massive strategy playing out behind those everyday things?
It's huge, isn't it? For companies like Reckitt, who make so many of these health and hygiene products we all use, there's this constant churn of strategic moves, financial juggling,
And innovation too, surprisingly.
all just to get those products onto the shelves and ultimately into your home.
Welcome to the deep dive. Today, our mission is basically to give you a shortcut. We want you to be really well informed about Reckitt Benckitt Group. We've been digging into their latest half-year 2025 performance review, the financials, the strategic updates. And our goal is simple. Pull out the most important bits, help you understand how this industry giant is reshaping itself, what the numbers really mean, and, well, what they see coming down the road. All pretty quickly and thoroughly.
And the headline figure right out of the gate, it's actually pretty compelling. Reckitt's main focus, well, what they call core Reckitt, that's their high-growth, high-margin power brands. Well, revenues there grew an impressive 4.2% in the first half of 2025.
4.2%. Okay.
Yeah, and that's not just a number. It really signals that their big strategic shift, prioritizing these key brands, it's already paying off significantly, especially when you look at the wider market where, frankly, a lot of competitors are struggling with volume.
That is a strong start. But to really get how they're doing that, we probably need to look back a bit. It was exactly a year ago they announced this new strategy, right? This
Yeah.
fundamental transformation.
That's right, aiming to become a, quote, world-class health and hygiene company. And it really boiled down to two things: laser focus and, crucially, exceptional execution.
Laser focus. And a big part of that focus seems to be this core Reckitt idea, putting all their weight behind the most powerful brands.
Precisely. And they've made a really decisive move to back that up. They've just agreed to divest their essential home business.
Right, saw that.
It's significant. It's not just about, unlocking cash from the sale, though that's part of it. It's really a strategic simplification. They're
Yeah.
shedding a business that, okay, it was profitable, but maybe didn't quite fit that tight health and hygiene focus.
So it lets them concentrate resources.
Exactly. Redeploy capital where it really fuels that new vision. And interestingly, they're actually staying on as a minority investor, so they clearly expect some decent returns from that business going forward, too.
Okay, so strategic simplification driving strength. And another key piece seems to be this Fuel for Growth program. That's about efficiency, right? And reinvesting savings back into the core brands.
That's the idea. And what's quite striking is that it's apparently delivering ahead of schedule. They
Right.
managed a 190 basis point reduction in fixed costs just in the first half of this year.
Okay, 190 basis points. Remind us what that means in simple terms.
Sure, a basis point is just 1/100%.
Okay.
So under 90 basis points is a significant 1.9% cut in their fixed cost base relative to revenue.
Got it. 1.9%.
And if you connect that to the bigger picture, their ambition is, well, it's pretty bold. They're targeting a 300 basis point reduction overall by 2027. That would take fixed costs down to about 19% of net revenue, compared to 22% back in 2023.
How are they achieving those early savings?
A lot of it seems to be coming from organizational simplification. Specifically, they've streamlined management layers, cutting from 5 down to 3.
Wow, that's quite a cut.
It is, and also what they term right-sizing legacy investments. So basically, it's not just about cost-cutting for its own sake. It means fewer bureaucratic layers, hopefully faster decision-making.
Making them more nimble, presumably.
Yeah, responding quicker to market changes, getting new products out faster. That's the theory.
Okay. And what about the Mead Johnson nutrition part of the business, MJN? We know they've had some challenges, particularly after that tornado hit their Mount Vernon facility last year.
Right. Mead Johnson Nutrition is still very much in recovery mode from that tornado's impact. But the signs are encouraging. They are showing market share recovery in North America, which is key, and performance internationally looks pretty good too.
And the long-term plan for MJN.
Well, officially, the company's stance hasn't changed. They're still saying all strategic options remain under consideration.
Okay, so still a bit of a question mark there.
It raises that question, doesn't it? What are the biggest uncertainties or pressures still facing MJN, and how might that ultimately play into Reckitt's overall portfolio decisions down the line? It's one to watch.
Definitely. Okay, so these strategic moves, the divestment, the efficiency drive, they're clearly designed to impact the bottom line. Let's dive into the actual financials for the first half. What are the numbers telling us?
Well, as we said, Core Reckitt really delivered that 4.2% like-for-like net revenue growth for the first half, and it actually accelerated in the second quarter to 5.3%.
And just to clarify, like-for-like growth means
It filters out the noise, basically. Things like acquisitions, divestments, currency swings. It gives you a clearer view of the underlying sales performance of the ongoing business. The total group, including the other bits, grew 1.5% like-for-like over the half.
And crucially, what about profitability?
That's where it gets really interesting. Adjusted operating profit grew by a pretty robust 7% at constant exchange rates.
Constant exchange rates meaning stripping out currency fluctuations.
Exactly. So you see the real business performance. And that 7% profit growth significantly outpaced the revenue growth.
Which means margins improved.
They did. The adjusted operating profit margin went up by 110 basis points. That's 1.1 percentage points to 24.6% for the whole group. And within Core Reckitt, it was even higher, hitting 25.9%.
Impressive margins.
Very healthy. And that feeds through. First half's earnings per share grew 4.4% to 168.4 pence. And they generated decent free cash flow, too, $623 million.
So financially, it looks like the transformation is bearing fruit. And they seem keen to share that success with shareholders.
Absolutely. Clear commitment there. They've boosted the interim dividend by 5%, up to 84.4 pence per share.
Okay.
And on top of that, they've announced a new 1 billion share buyback program. That's quite something. It brings the total amount they've committed to buyback since 2023 up to a huge £3 billion.
£3 billion. Wow. That's serious cash return.
It signals real confidence. And that confidence is backed by their improving market position. They reported that 59% of their top CMUs, that's category market units, think key product segments in key markets were either gaining or holding market share through the first 5 months of the year.
Almost at their target.
Very close to their 60% target, and showing sequential improvement. It suggests their biggest brands are getting healthier in their most important markets, which is, fundamental for sustainable long-term growth.
Okay, let's broaden the view now and look at the global picture. Performance isn't uniform across regions, is it? There seems to be a real divergence.
There really is. And the standout story, without a doubt, is emerging markets.
The growth engine.
Absolutely. It's their largest region now, and by far the fastest growing. They delivered exceptional growth, 12.8% like-for-like for the whole first half, and it even accelerated to almost 15%, 14.9% in Q2.
And is that just price increases, or are they selling more stuff?
That's the encouraging part. It's balanced. Good mix between volume and price. Volumes themselves were up over 7% in the second quarter.
That's strong volume growth in today's climate.
It really is. And you see specific successes driving it. Dettol in India and China is doing very well. Their intimate wellness brands, Durex, Veep, Intima, particularly in China. Get this. Intima sales there have more than doubled in just 12 months.
Doubled? Wow.
Yeah. And Latin America is strong too. Brands like Vanish and Veja in Brazil are performing well.
Sounds like they're using tech and changing their approach too. You mentioned online capabilities.
That's right. They've really ramped up their online presence, particularly in China and India. And that's translating into physical presence too. They've increased their store coverage in India now to over 1 million outlets.
1 million outlets. That's incredible reach.
And it's not just sales growth, but profitability in emerging markets is improving significantly, too. The adjusted operating margin there jumped by 270 basis points, 2.7 percentage points, up to nearly 20%.
So huge growth and better margins.
Which does make you wonder, how much more runway is there for this kind of growth and margin expansion in these really dynamic, critical markets? It feels like a key part of their future success.
Okay, let's shift to Europe. The picture there sounds, tougher.
It's definitely been more challenging, but there are signs of things stabilizing, which is positive. The region saw a small like-for-like decline of 0.9% across the first half.
But improving.
Yes, it improved significantly in Q2, where net revenue was basically flat. So the trajectory is heading in the right direction, suggesting stabilization.
Any specific bright spots in Europe?
Yeah, a couple of encouraging things. Finish, their dishwasher detergent brand, has apparently regained market leadership across all its biggest markets. They put that down to better operational execution and being more competitive on price. And then there's a really interesting innovation story. The European launch of Durex Intensity. It's the first ever condom made of nitrile, a different material.
Nitrile. Okay.
Yeah.
How's that doing?
Remarkably well, it seems. It quickly grabbed a 3% market share in France, Germany, and Spain. And apparently, it's already a top 10 best-selling condom on Amazon in those markets.
That's fast traction.
It really is. Shows that science-led innovation, when it hits a consumer need, can resonate very quickly.
Okay, and finally, North America. It sounds like that region faced some specific headwinds.
It did. Like-for-like net revenue, there declined by 1.7% in the first half. And Q2 was softer, down about 3.6%, largely because of the Mucinex Sinus shelf reset.
Ah, yes, the PE-free products. Explain that a bit.
So they had to reformulate their Mucinex Sinus products to remove phenylephrine based on efficacy concerns raised about that ingredient. They proactively pulled the old stock and replaced it with the new PE-free versions. That disruption, pulling product off shelves, inevitably hits sales in the short term.
But it was planned, a necessary step.
Exactly, a necessary disruption. But despite that headline decline, there was underlying strength elsewhere. E-commerce and club channels performed well. Point of sale, what's actually selling through the tills, was up mid-single digits in club stores and over 20% in e-commerce.
So consumers are still buying, just maybe through different channels or other products.
Seems so. And Lysol continues to be a powerhouse. Lysol air disinfectant spray gained over 700 basis points of market share. Lysol laundry sanitizer, almost 500 basis points. These are huge gains, boosting Lysol's overall household penetration.
And they're investing in production there too.
Yes, to improve supply chain resilience, which has been a challenge globally. They're building a new manufacturing site in Wilson, North Carolina. The goal is to bring over 80% of their U.S. Mucinex production back domestically when it's fully operational.
A big move for supply chain security.
Definitely. A strategic investment in stability and control for a key brand.
So listening to all of this, it feels like it's not just about selling widgets, is it? It's about really understanding consumers, creating demand, sometimes even creating whole new categories. Innovation seems critical.
Absolutely critical. They talk about building and growing iconic brands that don't just compete in existing categories, but actively create new ones.
Can you give an example?
Dettol in China is a fascinating one. Back in 2019, Dettol mainly played in about 3 hygiene segments there. Today, it's expanded into 9 different segments.
9. Wow.
Yeah. Including things like launching a plant-based version of their classic antiseptic liquid called Active Botany. It shows how even a very established traditional brand can evolve and find new growth avenues by tapping into new trends like plant-based products.
On the Mucinex example we discussed, that's innovation too, isn't it? But more strategic.
Exactly. That shelf reset wasn't just about swapping ingredients. It involved significant R&D for the reformulation, removing the phenylephrine, but it also required really smart market execution, timing it carefully, doing it ahead of the peak cold and flu season to minimize disruption when demand is highest. It's innovation combined with strategic planning.
Are they using newer tech, like AI, in any interesting ways?
They mentioned using generative AI specifically with their Finnish brand. The idea is to make their marketing concepts more effective, test them faster, and do it more cost efficiently. It's an example of embracing digital tools not just for consumer-facing stuff, but to improve core internal processes like marketing development.
Interesting. And that Direct's Intensity launch we talked about in Europe.
Yeah, that really highlights their focus on science-led innovation and what they call consumer obsession, identifying an unmet need or opportunity in this case, maybe for a different material, developing the product through R&D, and then launching it effectively to gain that impressive market share so quickly. It's a good sign for their innovation pipeline.
So bringing it all together, what's the outlook? They sound pretty confident, even raising their guidance.
They do sound confident. Based on that strong first half, they've officially raised their full year 2025 target for core Reckitt. They now expect like-for-like net revenue growth to be over 4%. Which is up from the 3–4% range they guided previously.
Okay, an upgrade for the core business.
Yep. And for the total group, they now expect growth in the 3–4% like-for-like range. And importantly, they expect adjusted operating profit to keep growing ahead of that revenue growth.
Meaning margins should continue to improve.
That's the expectation. The savings from that Fuel for Growth program are meant to provide the firepower for increased investment behind the brands while still allowing for sustainable margin expansion over time.
That sounds good. But are there potential clouds on the horizon? Any major headwinds they need to navigate, especially in those trickier markets like Europe and North America?
They certainly acknowledge the operating environment, particularly in Europe and North America, remains, uncertain. There are ongoing shifts in retail channels, the rise of discounters, online growth, and obviously persistent competition.
How are they planning to deal with that?
They basically say they feel well equipped to navigate it. Interestingly, they mentioned they are not seeing abnormal levels of promotional activity from competitors right now.
So no major price wars breaking out, it seems.
Apparently not, which suggests Reckitt feels they can compete based on brand strength, innovation, and their operational improvements, rather than having to rely heavily on deep discounts.
Okay, and one last check on margins, gross margins. They expanded a bit in the first half by 40 basis points. What about the second half?
They were quite clear on this. While H1 saw that expansion, they're not looking for further significant gross margin gains in the back half of the year.
Why not?
They're signaling a choice. They plan to make smart investments, particularly in supply chain resilience, maybe holding more inventory, diversifying suppliers, and also absorbing potential headwinds like tariffs, rather than passing everything straight through to price or letting it hit the bottom line immediately.
So prioritizing stability and competitiveness over squeezing out every last basis point of margin in the short term.
That's how it sounds. More of a long-term strategic view on maintaining a healthy, resilient business.
Okay, so let's try and wrap up this deep dive into Reckitt's half year. The big picture seems to be that this strategic reshaping they embarked on, it's working.
It really does look that way. The divestments, focusing on core Reckitt, the Fuel for Growth efficiency program, these are not just buzzwords. They seem to be delivering tangible results.
We're seeing strong financial performance, especially driven by those emerging markets and the key power brands. It feels like they're positioning themselves pretty effectively for continued sustainable growth.
Yeah, the momentum seems positive. They've set a clear direction, and so far, the execution looks pretty solid.
So, as you, our listener, reflect on all this, here's maybe a final thought to mull over. We often focus on the products themselves, right? But how much of a company's success, like Reckitt's, comes not just from the Dettol or the Mucinex, but from the fundamental operating model behind it all? How much does that deliberate choice to simplify, to focus, to become more efficient behind the scenes actually contribute to making those brands you trust shine even brighter on the shelf?
It's a great question. What does it really take for a huge, complex legacy company to genuinely reshape itself in today's dynamic world and unlock that potential? It's about more than just selling soap, that's for sure.